Hello, and welcome to part 2 of our accounting tips for larger businesses. In part 1, we discussed the difference between price and cost when getting quotes for jobs you need done. If you have not watched that video yet, it's called the Accounting Series for Larger Businesses, Part 1, Price versus Cost. Alright, so now let's look at the example we had in the previous video. So in that video, we had 4 different quotes from companies who could do a bathroom renovation in a restaurant, and we concluded that the quote for $23,000, with $13,000 in cash and $10,000 in barter, was actually the cheapest quote. We showed that the $10,000 in barter credits only cost the restaurant $5,000 in Canadian dollars, so the true cost was actually $18,000 Canadian. Now let's look at how we handle the 10,000 barter credits in our accounting software. Basically, we're going to look just at the $10,000 component and not everything else. You can look at the other invoicing of things and obviously follow that through into the departmental side as well. But we're just going to focus strictly on that $10,000 that was coming through on barter. As we acknowledged in the previous video, if you were to put that $10,000 expense entirely against the purchasing department, or we have one here called building and property management, that's where it would go. Your folks in the building and property management department are the ones making the bathroom decision. They're the ones whose budget is impacted by that expenditure. When they're looking at the $10,000, there are 2 main ways to split it up and manage your departments in a way that can make their budgets make sense. One is to allocate a portion of the barter revenue to the department that is making use of barter in sort of an inter-region and inter-department allocation. The other option is to actually set up another department that you call the BarterPay clearing department. So I'm just going to set that up. And we're going to say that we're expensing the bathroom renovation. I realize that in some cases, or eventually in all cases, you might be capitalizing that, but still, you'd have a capital budget that you'd be tied to. So whether you're talking about the capital budget or the expense budget, it doesn't really matter. And so we'll just say it's an expense for this example. Let's say you're going in here doing a vendor bill. If you've been watching some of my other videos with respect to accounting, we got Steve's contracting as the contractor we want. So Steve here has given us a barter invoice and also a cash invoice. In this case, we're dealing with the barter invoice. Anytime I say cash, I simply mean Canadian dollars. Obviously, if you're a big corporation, you're likely cutting a check, not handing Steve cash. And you likely have a purchase order. If so, let's say that's your purchase order. You have your bathroom reno, and we're just going to throw it, like I said, throw it through an expense line, general expenses. We said it was going to be $10,000, and we're going to assign it to a department. So in this case, in the case where we are saying it's all going against that department, you could have a senior management person saying to the building and property maintenance department, sorry, that's the way it is. Work with it. It's better for the business overall. But then it gets forgotten, right? So it's part of the overall budget. Now they're chasing to try and save because there's a $3,000 difference, and they're chasing to try and save $7,000 somewhere else. So we have the invoice. So that invoice right now has been totally allocated towards the building department. From here, if that's what you've done, you could allocate part of the sales. So you could say, okay, well now, BarterPay is going to send sales against that. And so we're going to do it as a journal entry, and you could say that you're going to allocate some of the sales. So future sales, let's say, since we're a large restaurant chain who needs the bathroom renovation, we're going to do a big catering job for somebody as a result on barter to cover the 10,000 barter credits for the reno. And they're going to allocate that from the sales department or a portion of it. So let's say that 50% of all sales that are done on barter get allocated away from the sales department. So $5,000 gets allocated away from the sales department, and it gets reallocated to the building and property maintenance department. For the purposes of sales tax and income tax on your financial statements, the barter sales should be properly allocated as sales and shouldn't be offset against expenses. They are sales, and expenses are expenses. And so that's why in this case, we were allocating it so that the building and maintenance department actually has sales as part of it. So now if we look at the profit and loss for the building department, this is the only thing it has in it right now. So we're going to do a department, And we're only going to look at the Building Property Management Department. So normally the Building Property Management doesn't have sales, but in this case, now that we're talking about barter, now it has this $5,000 sale. And then it also has this $10,000 expense, meaning that instead of the $10,000 expense counting against them, and against them in full for barter, it's actually only counting against them for $5,000. So now when you take the total expense, which is the 13,000 Canadian dollar invoice, the cash portion of the bill, and now this $5,000 net cash expense of barter credits, now they're being properly charged at the $18,000 in terms of their budget. And so now they're making the correct decision in terms of which contractor to pick on that job. So that's one way of managing the allocation between departments. It is to basically say, okay, well then we will do an interdepartment allocation based on whoever is utilizing the barter. This is a simple way to properly record what's really going on in your business. However, if, for whatever reason, you don't want certain departments showing sales on the books, there's another option, and we'll walk through that right now. The other way to do it is to have the BarterPay clearing department take some of the expense. So we're going to go to our journal here, and we're just going to remove that journal entry. So that's gone. And now we're going to look back at that vendor bill again that we've already input, which is right here, and we're going to edit it. So instead of saying the whole bathroom reno cost on the barter side is going to go towards the building department, we're actually going to break the invoice down and send 5,000 of it there. 5,000 is going to the BarterPay clearing department. And so we're recording that and saying, okay, well, that's how we're going to manage the barter credits allocation. So now I'm going to post that side of it, and then we'll talk about the sales side, because whatever you do on the expense side, you have to mirror or match on the sales side. But before that, when you look at the profit loss for that department, so now we're looking at that building and property maintenance department again. You can see now we've removed that sales adjustment and we've adjusted the general expenses so that it only reflects the $5,000 that is the cost of the barter credits that are being flowed through. And so the net, including the $13,000 that is in Canadian dollars, the net cost is $18,000, which, once again, is cheaper than the $20,000 that they otherwise would have spent. And so instead of being negative $20,000 in terms of the loss, it would only be negative $18,000. Now to the question you obviously have right now regarding the sales department. So on the sales side, when looking at the barter credit sales, you'll want to label your BarterPay customers, or you'll want to allocate certain revenue streams as being the barter revenue streams. Or if you just have bigger barter transactions that are isolated, then that could be easier too. So let's say that BarterPay arranges a big catering job for the restaurant, and it's going to be, conveniently enough, it's going to be $10,000 in barter as well, plus the tax. So when they're issuing that invoice, we would suggest splitting the Canadian dollar and the barter credit portion of the invoice, because it makes it sometimes easier to keep track of. Okay, so they do the catering job for Bob's Truck Rentals. And we'll say they're in Ontario, and it's called Sales Products. Save. So now we do the same thing, but kind of the reverse side. So it's a catering gig, and we'll put it under Sales Products. And then we're saying $5,000 allocated to the sales and marketing department, and $5,000 is being sent to the BarterPay clearing department. And so there's clearing, and there is the sales and marketing department. Now, obviously, there's going to be costs associated with that. So for the sales and marketing department to do an additional job like that, let's do a vendor bill here. And obviously, this is being made very simplistic, but let's say that we have a food and beverage vendor who takes care of all of it. Now let's say this vendor doesn't actually take barter credits, so that catering job comes to $3,705 Canadian. And that cost will be allocated to the sales and marketing departments. And so now, when you look at the sales and marketing department, You can see they've been given credit for $5,000 of the $10,000 in sales, of which they have a cost of $3,705 Canadian, meaning that their net profit is $1,295 on that transaction. And the barter credit clearing department ends up netting out to zero. Obviously, if there's a time where you've done some sales and you haven't spent it yet, then for a period of time, the BarterPay clearing department will appear to have a profit. In times where you have spent more than you have earned in barter, then in that time frame, the barter credit clearing department will appear to have a loss. But really, overall, the BarterPay clearing department should be zero. The key is that whatever the ratio of barter credits are that you're allowing the purchasing department to use, the sales department has to be using the same ratio of credits. An individual owner who is managing a business is basically making the decisions unilaterally and will look at the purchases and sales all at once and be able to see the benefit right away. Whereas when you're a larger company and your employees are making decisions across different departments, they need to be given the tool to make the proper decisions and to see the bigger picture. And it's very simple. All you need is for the accounting and finance department to set the percentage rate that they're working on for evaluating the barter components of transactions. If you need help with that, your barter coach is here to help. Also, if you want to chat with our accounting department here at BarterPay headquarters, we will do everything to make sure that you are benefiting from barter and maximizing it within your business in the most profitable way you can.